So, before further ado, I'd like to request Mr. Dhan Thapa, Head of Programs and Assistant General Manager at NBI, on the stage for his welcome remarks. Thank you.
Distinguished guests, so the speakers and the panelists, delegates from different banks, my colleagues, ladies and gentlemen, good morning and namaste. I'm Dhan Thapa from National Banking Institute. First of all, I would like to take this privilege and honor to welcome you to the program. Thank you so much for participating. National Banking Institute, as you know, is the national level apex banking and finance academy established by the industry for the industry to build up capacity of the human capital in the banking and finance sector of the region. Right from its inception back in 2010, National Banking Institute is fully engaged to achieve its mission. NBI is constantly exploring to introduce international level trainings and the academic programs and the certification courses, professional certification courses to the Nepalese banking industry. Among various trainings and academic programs and certification courses, conferences are one of the major components of our activities. National Banking Institute conducts this sort of conferences on various pertinent topics on a regular basis. Last month, we conducted one conference on anti-money laundering, and this time we have chosen Risk Management Conference. So, Risk Management Conference, in fact, is our annual event. We do conduct Risk Management Conference every year, and we have already conducted several episodes of Risk Management Conference in Nepal, inviting international speakers and local experts. Risk is inherent in any business. And banking is not an exception. In fact, banking is the most susceptible industry to risk management. And if we talk about the present scenario, risk, the frauds and financial crimes are increasing day by day. We see the news about financial crimes and the frauds hitting the newspaper headlines almost every day, if you see the newspapers. So this situation is very, very vulnerable at present. And keeping this in mind, we have organized this one-day risk management conference today. And the main purpose of risk management conference today include to bring in the global perspective of risk management framework to the Nepalese banking industry, to discuss and enhance awareness on the impact of COVID-19 on risk management, and to provide a platform to deliberate on the contemporary issues and challenges faced by the banks on risk management. I hope these objectives will be met today. And let me briefly talk about how the program is structured. This is a one-day program, and we have 3 paper presentations on different topics related to risk management, and followed by 2 panel discussions. And we have invited international speakers from India and the local experts to facilitate the program. And we tentatively plan to wrap up today's program by 5. So once again, I wish you a very warm welcome to the program and look forward to your active participation to make the program a big success. Thank you and happy learning. Okay, so without taking further delays, I would like to go to the formal session today. The first presentation that we have is on the Operation Risk Management in Indian perspective. And for this presentation, we have invited Dr. Srinivasa all the way from India. Let me briefly introduce, he has a long profile and I will briefly read his profile. He's a career banker with a premier public sector bank in India, Bank of Baroda, and he has experience of working as branch manager to general manager in the bank in India for over 3.5 decades. His multiple roles and responsibilities in the bank provided him deeper understanding of banking operations. Strengthening his domain expertise in banking, operations and finance, he moved into a teaching profession to share his experience with the next generation of students and leaders. And he worked as associate professor in National Institute of Bank Management, NIBM, Pune, and had been director of National Institute of Banking Studies and Corporate Management, NIPSCOM, and currently teaches risk management as an adjunct professor at the Institute of Insurance and Risk Management, IIRM, Hyderabad. And he has written and published 2 books on banking based on his knowledge and experience, with another 3 books under print. And his academic accomplishments include PhD, MBA, Finance, and LLB, besides the professional certification from Indian Institute of Banking and Finance. So, Dr. Rao is already here. Let's give a big hand to welcome Dr. Rao. So, I would like to invite Dr. Rao for his presentation.
It is the wisdom and I would say the vision of the organizers of the conference that rightly the operational risk has been put as the first agenda of the conference. It is more so because of the developments that have been taking place. While we are very mindful about the catastrophic impact of the pandemic of the last 2 years, according to the recent Reserve Bank of India report on currency and finance, it will take for the whole Indian economy to streamline itself by 2034-35. That means it has eroded in different ways the grassroots in such a way that it will take a lot of time. That's what I was discussing with some of the eminent people present here. So why I am bringing that point, that brings to light the significance of managing operational risk, which has a wide manifestation, and it is omnipresent, it is omnipotent. Operational risk, and you will be making mark to market for the market risk, but the impact of operational risk, which stands on 3 pillars. I think all of us know very well, though I don't want to go into the definition part of it, because all of you have read a lot of literature on operational risk. It stands on 3 pillars. The first is human resources. The very, very critical part of operational risk is human resources. And human resources have different kinds of competencies and different kinds of skill sets, different levels of commitments, ethics, values, honesty, a lot of things as far as human resources are concerned. So that's the first part. Second is the technology. Now the technology, we always feel, like the banking industry always feels that technology will make people redundant. But if you look at the developments that are taking place, it becomes much more critical to develop human resources compatible to manage technology. Technology has to be tamed. It needs to work the way we want it to work. If human resources are not capable to do that, I think we are open to a disastrous risk, that is operational risk. So the human resources becomes the epicenter of operational risk, because you have to tame technology. You can't say that because of technology we have failed. No, because who has selected the various softwares and the hardware and the things like that, whether you are using artificial intelligence, whether you are using machine learning devices to expand your data analytics skills, you are choosing it. So it is human resources. So technology, human resources. The third, systemic controls. Checks and balances to control operational risk. Who institutionalizes systemic controls? You and I, human resources. So human resources is at the epicenter of operational risk. That is why all of you are here. My submission to all of you is, I have given 3 kinds of inputs in today's, because of the limitation of time. The first one one paper has been given that will be shared, soft copy, you can read that. And at various points, I have also given the references of the documents and research papers, which will be very useful for you to mine the information about the nuances of operational risk. Now, whenever we talk of operational risk, since we are experiencing now the impact of pandemic, the collateral damage that has been done by the pandemic, we talk about pandemic and its implications, and many of our entrepreneurs who are really good, but still they are at a very critical point of time now as far as their viability is concerned. We need to do the hand-holding process. Now, how you organize your hand-holding process, how you evolve your policies in that way and try to see that they match the requirements, that will take time, but we need to do that. But most important implications is the climate risk. The climate risk is not pursued by many of us at this point of time. But from the operational risk point of view, 3 risks will impact operational risk. It will expand the operational risk. One is the geopolitical risk. That is the things, the way in which the globe is reorganizing itself. It is it is an amazing thing. Whether are we globalizing? Are we making groups of countries where we will be dealing with each other? And what is the risk of that? And what are the implications of crude oil prices? And how our units will get affected? These are all some of the things which we need to look at. So, geopolitical risk, climate risk. Every time you will find one cyclone hitting the shores of, because we have global temperature rising, and we have COP. I think most of you must have already read about the resolutions that we make about the decarbonization of the economy. So decarbonization of the economy, if you want to make, then what is the wherewithal? Are we able to go into the non-conventional energy like solar energy, wind energy, and things like that, and how our units on which our sustainability depends. If our units are good, we are good, isn't it? So my only submission to the August House, please take care of your own skill sets and competency. The organization has 10,000 employees to take care. But if you are there, you are the only one person. You can take care of that. So mine your competency and see how you can control operational risk in your own way. So that is my submission as far as the beginning of this is concerned. Now, globally, risk is managed. First, we want to avoid risk, isn't it? We manage the risk with a lot of tools that we have. Operational risk has got a lot of tools. Now, since it is an invisible risk, I would always say it is invisible risk because it does not, in the near term, impact. And you will not be able to say, if suppose I am the auditor and I did not audit your balance sheet properly, you will not come to know for 2-3 years till provisions are going up or profitability is coming down or the return on assets are coming down over a period of time. You won't be able to attribute reasons for that. So if suppose the best of our efforts, we are not able to mitigate risk, what is the remedy? The remedy is to increase capital. Capital is one way of, that is the last resort. I don't say that we should eat our capital for the purpose of managing our risk. The first and foremost, we will avoid risk. Avoid means not avoiding business, but managing the risk. And we will not eat into our profits, eat into our capital. capital adequacy ratio, Basel, these are all interlinkages with operational risk. That is why capital comes into picture. Capital, Basel III has brought one very good feature, that is the quality of capital. That is Tier 1 and Tier 2 and AT1. Please read some literature on that. You will be able to understand the nuances of it. But the most important is how capital can be conserved. Who will do that? You and I will do. Again, it is operational risk. If I don't do that, if I want more capital, if I want to raise capital, there is a cost. If my bank is very good, I can get Tier 1 capital. If I don't, then I will have to go for Tier 2. And if the ratio of Tier 2 is more, then it doesn't comply with Basel norms. So these are all some of the implications. So take care as far as the operational risk is concerned about, and we know very well that operational risk has come to the lexicon of banks only in 2004. It is not that before 2004 there was no operational risk, but the systemic controls and the recognition of operational risk has come to play, has got a recognition in 2004. 1988 Basel I brought capital, credit risk. 1997 amendment of Basel I brought market risk. 2004 brought operational risk. So we should always remember that 2004 is the benchmark where the operational risk has been recognized by the system internationally. And these are all some of the international case studies where slackness in risk governance, all these case studies are very well known to all of you. You might have read in some financial dailies, or you must have read in some literature. Go back to Barings Bank collapse. If you go into the history of Barings Bank collapse, then that was in 1995, you will find that over-dependence on people and slackness in the control has precipitated into, so those of you who have an interest in the treasury operations, you will be able to better understand how Barings Bank has only one person, Nick Leeson. He could contaminate the whole bank and made it to collapse. That is the operational risk. So when we are working, our eyes and ears must always be sensitive towards what is happening. Any ticking anywhere in the balance sheet, you should be able to capture. That is the risk. That is the operational risk management. These are, you go to Enron scandal, go to Arthur Andersen collapse. They were the chartered accountants, leading global chartered accountants. But they have certified the fudged balance sheets of Enron, and both have collapsed. That is the operational risk. That is why in the beginning only I was insisting that any risk, that is the probability of loss, is on account of you and me. If we are sensitive, at least on a scale of 1 to 10, if your risk management capability is at 5, you can take it to 8. A very good job, operational risk. If you are able to take the index from 5 to 8 in your organization, you can never take it to 10. That's very hypothetical. You will never be able to take it to 10. It's because we do business. And in business, there will be risk. So you can't say that I will be riskless. Because what is business? Business is making money from somebody else's loss. Very simple. Unless somebody, maybe that he is paying as a value of services, But somebody is parting, somebody is gaining. That is what is business. So if that is done, then there will be risk. So any risk on a scale of 1 to 10, 8, 8.5, 7.5 is a good going. So always measure what is the riskiness. And not many tools have developed as far as operational risk is concerned. Why it is not developed? Credit risk, we have a lot of tools. There are risk rating agencies, there are internal rating modules, there are policies, there are risk appetites, there are exposure norms, there are liquidity coverage ratios, there is leverage ratios. So there are a lot of, but operational risk, you don't have too many. Except because it is very sensitive. And what BIS has benchmarked as far as operational risk is concerned, 15% of gross earnings of the last 3 years, please provide, because there is no benchmark. Means still evolving. Maybe that your generation of bankers, maybe in the next 5 years, we will evolve better tools of measuring the operational risk. But as of now, skill building is the only perceptible thing that we can. So all these, just go through, it will be very interesting for all the youngsters like you to go through what has happened and why these scandals, despite having risk management. Everybody is having risk management, isn't it? We have best of policies, best of people, but still things happen like this. Come to India, Indian perspective. The glaring one is the failures of Global Trust Bank. Yes Bank was on the brink of collapse, but somehow rescued. And then we have the biggest fraud, that is the Punjab National Bank, 14,000 crores. Why it happened? It is not that anyone wanted it to happen, but there were chartered accountants who have certified. There are internal auditors who have certified. There are job rotations in the organization. There were internal controls. There were checks and balances, but still it happened. For 7 years, it was going on, and nobody has seen, because we are very, very confident when we deal with things that it will never happen. That is why the youngsters like all of you have to be very, very sensitive. Even the, what you call, the paper makes noise, no? If you turn the page, it will make noise. We should be sensitive to capture that noise and try to arrest it. So IL&FS, I think all of you might have read a lot about infrastructure leasing and finance company. It's a very big bank, big NBFC. 1 trillion rupees loans banks have given. So if my credit risk assessment is causing, that is why whether it is credit risk management or market risk management, there is operational risk in that. Every risk has operational risk, because only people do it, no? You and I do it. So come to PMC Bank collapse. PMC Bank, it has now been merged with another small finance bank, and there was a lot of struggle, and there was deposit insurance in India of 1 lakh rupees for all depositors. It is now raised to 5 lakhs because of the hue and cry of, but 5 lakhs, will it suffice unless your operational risk is good? No. 5 lakhs, what will happen in 5 lakhs? Nothing, because you may be having retirement funds in the bank, your parents might be having. So how they will manage that if they have a shock of this kind? So PMC Bank, which has merged with Unity Small Finance Banks. Here in India, there are basically 4 kinds of banks: the big commercial banks, foreign banks, small finance banks, and payment banks. And all public sector banks have regional rural banks, that is the RRBs which we call. So they are meant to serve the rural community. So these are all some of the Yes Bank. And Lakshmi Vilas Bank, one of the south-based bank in India, was known as a very good bank as far as customer service is concerned. But all of a sudden, within 2-3 years, its balance sheet started eroding. Its capital adequacy has become negative. Because if you eat, then what happens? It will take away your capital. If your profitability goes into loss, then what will happen? It will erode your profit net worth. And as a result, it has to be merged with DBS Singapore. DBS Singapore is having India operations, and they have taken, because a good network of branches, so they got the advantage. So these are all some of the Indian case studies, which all of you should, whenever you get time, I say that you are all very busy people, but still, you can take that curiosity, you should have the curiosity to read them and understand then how this has happened. And can it happen in our bank? It should not happen. So take a cue from there. Because why we read case studies in all B schools? Without making the same mistake, you learn from them. That is the very crux of having case studies. So these are all some of the case studies. These are global case studies, and these are Indian case studies. Just look at them, and you will understand the nuances of it. And there will be some takeaways. At least to that extent, you can risk-proof your activity. I say that we should risk-proof our activity, whatever we are doing. If you are opening an account, KYC, anti-money laundering. If I am doing SME, MSME accounts, whatever I am doing, you may say that I am not dealing with risk because I am not appraising the credit. But you are following up the loans, or you are handling the liability side of the balance sheet. Do that efficiently, risk-proof. If all of you risk-proof, organization is risk-proofed. So keep that in mind. So these are all some, why operational risk is becoming more complex. I think all of you must have read in the paper about VUCA. I think VUCA is a terminology which is making the business environment very complex. Volatility, uncertainty, complexity, and ambiguity. VUCA is a concept now building up. Read some literature on that. Because the whole business environment in which we are operating is engulfed under VUCA. That is coming from 3 risks which we discussed. That is geopolitical risk, climate risk, and catastrophic risk. Catastrophic risk is the pandemic risk. Now pandemic may go, but it will linger on in the society for another 5 years, 6 years to come, depending upon. So your risk is more complex. So you have to manage your existing balance sheet keeping VUCA in mind. Because VUCA is going to make the business environment. Now you may say that I may not change, but if my entrepreneur is changing, the risk is passing on to us. So that's the complexity of the risk. So if you are very efficiently managing today's balance sheet, that will not protect your bank, or your operational risk will not be protected in the long run unless you factor VUCA. So factor VUCA so that you will be in a position to understand the nuances of how it can change the entrepreneur's balance sheet. Because entrepreneur's balance sheet passes on to bank's balance sheet. That linkages you should be able to establish because operational risk is to be managed. These are all the risks which we need to keep in mind. Now, what are the prime reasons is we are very busy and we need to lack of upgradation of skills. And most important, risk reading ability. Now you will say that I read lot of books, very good. But are you able to are you sensitive enough to read the riskiness that is around you in your environment? Now you may say that I am very safe. If my entrepreneur is not safe, tomorrow he will default. And that will come to me. So what we need to do, we just now we were talking about with one of the CROs here, that we will have to change our mindset in reading the riskiness with not past tools, but with future vision. That you will have to make a change. So, as far as risks are concerned, there are tools like, if it is, there are three kinds of operational risk. We can divide into three areas. One is operational risk. Operational risk means it affects the whole organization. If operations risk, it affects the local environment, that is the branch or the district or the province. Like suppose, I think during lockdown we have seen that there were hot spots, that this area, it is very contaminated, so you seal them with rest. So similarly, we have, as far as technology is concerned, disaster recovery. I think all of us know how to protect our data protection, and avoiding your cyber security and things like that. So people risk is I have put it as the highest risk, because you should be able to read. Risk reading ability we have to increase. Risk reading ability we have to increase. Attrition rate. What is attrition rate? Means the moment good people leave your organization, it is a threat. People retention, compensation. Now again, compensation should not be more. Because in order to get more compensation, they will take more risk and put the organization to huge risk. That is why in SEBI guidelines in India, SEBI Securities Exchange Board, there is a clawback of bonus. Means they will give good money to you because of good performance, but later on, because of operational risk or credit risk, it turns out to be otherwise. Then you can claw back that is the provision as far as the regulations are concerned. So, disaster recovery. Now, there is another big thing that is coming up now, is outsourcing. You are trained, you know banking, but the people who assist you with outsourcing, they are not competent. They are not paid well. They are there for 2 months, they go out. Somebody else will come. So outsourcing risk is operational risk. Please take care. Wherever there is outsourcing arrangement, please see that. Slackness in internal and external audits. Please do not take internal audit report very casually, which many of us take, including when I was branch manager, I was also taking that. But now I have learned after a long ordeal that inspection report of your internal auditors is your career for future, your future career. So please keep that in mind, that if you rectify that today, your own risk is managed. So please don't take that without. Now, I think, this is going back. Okay. Now, I was telling about operational risk versus operations risk. Like your local area is an operations risk. If you have operations risk, you should understand the three different kinds of branches as far as operational risk is concerned. One is operations risk, operational risk, and operational crisis. And for everything, there is another different kinds of tool. Operations risk, risk manual, and policies of the organization. You have to modify if like today, because of the catastrophe, that is because of the pandemic, we have operational risk. That means the risk is everywhere, throughout the organization. So if it is throughout the organization, then it is operational risk which hits the whole organization. Operations risk is outsourcing risk, back office operations. These risks are not throughout the organization, in small geographies, but it will perpetuate, it will escalate into whole organization. And we have operational crisis. Operational crisis requires BCP, that is business continuity plan. Now, all of you as a branch people, suppose you are working in different areas in the branch, you may not be concerned with BCP, but you should read it. You should read it. You may not be part of it, but please read it. It will give a lot of insight as to what is business continuity plan. A very small example of business continuity plan, if your branch is having 5 staff and 2 people do not turn up tomorrow because of some sickness, how do you manage the branch? You have an internal BCP that I will look after these 2 desks, he will look after these 2, she will look after this. That is BCP. So BCP in a miniature form is understood to us, but BCP as an organizational pan organization, you need to do that. So understand the difference between operational risk, operations risk, and operational crisis. Operations risk is a local risk. You have to build SOP, standard operating procedure. Suppose many of your account holders in a branch, HNIs, which we call high net worth individuals, they are closing the accounts. Why they are closing the account? That is a business proposition, but it is an operations risk. So whatever action you will take to rectify that position is through standard operating procedure. You will change the standard operating procedure. For operational risk, change the policy. That is what we were discussing in the morning. Because of the pandemic, the old rules may not work. You have to rewrite your rules, your policies. Because historically we know that we should lend to people who are viable. But now you have to lend to people who are not viable, but potentially viable. That is the change. So you will have to rewrite the rules. So in operational crisis, BCP has to be revisited every time. Like all central banks world over, all banks have BCP. They have disaster recovery. They have manual of operations. They have standard operating procedures. These are all tools of risk management as far as operational risk is concerned. Kindly see that. Now, oh, these are all going back. So please now, how to manage the risk? We have just discussed about what is operational risk, what are the implications, what are the nuances, VUCA and all these things. But then, does it mean that it is not manageable? It can be managed. Operational risk can be very effectively managed, and you can raise the bar of management from, on a scale of 1 to 10, if it is at 5, you can take it to 8. How? BIS has given 10 broad, 11 actually, 11 broad parameters. If you follow that, at least most of your risk will be controlled. There is no control there is no way in which you can control everything. You can't do that. Because as we discussed, business is dynamic. Board to develop risk management culture, ethics, and values. What is values? If I promise the customer, I will keep it up. That is the values. If I say that, please come to the branch at 9 o'clock in the morning, I will be available, then I will be available. That is the values of the organization. You will find in the market, if you take the name of a bank, they will say that bank people are very perfect. If they promise, they deliver. That's the kind of reputation that you need to develop. So, board has to inculcate. There are subcommittees of the board which drives this, the linkage between board and the management. Board and chairman is head of board, and the management, MD is the head of the management. So, this distinction we should be able to understand so that we can understand risk governance. What is risk governance? Risk governance is driven by, it is not driven by whether you give 10 crores to X company or 10 crores to Y company. It doesn't decide. But it decides the philosophy of the organization, whether we should expand credit or not. That is the risk management culture. And ethics and values. And, my dear friends, it has to be well documented. Any policy which is not well documented and disseminated down to the user is absence of risk management. So you should be very particular. Adopt ORM framework, operational risk management framework. This, who is saying? BIS is saying. Board to review policies. That is what we were discussing in the morning. Because no policy is perpetual. It should have a sunset clause. It should have an enabling clause. If it doesn't have sunset clause, dynamics of change cannot be incorporated in the organization. So that you should do. And fix risk appetite and risk tolerance levels in line with the SWOT analysis of the organization. What fits the asset size of a bank of 20,000 crores will not fit a 1 trillion rupees balance sheet size. It can't. A person with a small size cannot wear extra large, isn't it? It won't fit. So you should be able to understand and fix the risk appetite. Now, bank has fixed the risk appetite, but you don't know about it. Please get familiar with that. That is why in all the banks, there is something known as intranet and internet. The website is meant for public stakeholders, but intranet is for you, where policies are hosted. You will be able to share. Now, we have so much of electronic systems, digital systems to share knowledge. Do that. Board of directors should set a clear and effective, robust governance structure. These are, who is saying this? BIS, Bank for International Settlement, is giving guidance to all central banks. And Nepal Rashtra Bank will give the same thing to all of you. So you should get familiar with that. Identify inherent operational risk, because operational risk is different in different organizations. Banks change management process. Regular monitor operational risk profiles. What is a risk profile? How many of employees are senior, how many are junior, who are the specialists, who are the generalists, and what kind of qualifications they have, what kinds of skill sets they have, what is the talent that they are having, and that is not constant. So take stock of that. And banks should have a strong control environment that utilizes policies, processes, and systems. The process cannot remain constant. Process has to be changed. It has to navigate the business. That is the you and I should do, and that is operational risk. If you don't do that, and implement robust information ICT framework. Now you may say that is where there are systems audit. What is systems audit? Whether the software which I have taken is serving the intended purpose or not, it has to be verified. Later on, after 2 years of using the software, you can't say that no, it has not served the purpose which I intended. There has to be a user acceptance, and there has to be a system of auditing every technology tool that you are adopting. What are the nuances of it? If you don't do that, that is operational risk. So please be guided by BIS document. I have given the reference of that document somewhere in the presentation. You can see that. And ICT, why I give more importance? Because it was forming a very small part 10 years ago, but now it is becoming predominant. Technology is predominant now. Fintech companies are coming. NBFCs are coming. Everybody is joining each other. There is a huge jugglery of transfer of risk. Risk is transported from one company to another. In this traffic of risk, you need to understand ICT framework, and then you will be able to do that. Now, these are the BIS guidelines, isn't it? Now, how those BIS guidelines have to be translated into a framework of operational risk management. Now we understood what is risk, what are the implications, what BIS is saying. There is a board, there is management, there are employees, there are stakeholders, there are users, there are units, there is profitability, there is balance sheet, everything we understood. Now, how to galvanize that? It is galvanized globally through a framework which is known as 3 lines of defense. If you are not familiar, those who are good in risk management, they will understand what is 3 lines of defense. But those who are not, please try to read some literature on that. There is a huge literature on 3 lines of defense. What is that? The first line of defense is those who are working in the branches. 90% of our workforce form part of business line. They are the people who open the accounts. They are the people who give loans. They are the people who follow up the loans. They see that NPAs are not increasing. So this segment of people are the most important set of people for managing operational risk. So first line of defense means, in security aspects, there will be first line, means you can't pierce that line. You will be thrown out. So risk should be thrown out by the employees. Now how they will throw out if they understand. So you should make 90% of your employees who are in the business line impeccable as far as the nuances of risk is concerned. If I am doing retail, I should know what is the risk in retail. If I am doing MSME, I should know. If I am doing with Forex, I should know it, implications. So if you know that, then your turf is protected. How it is? Your turf is protected. The first line of defense is our employees who are working at the grassroots level. I say they are God as far as the organization is concerned. Because if they don't do their job, the whole organization will collapse. That is the first line of defense. If your employees doesn't understand, ring fence the organization, protect the organization, there is no future. So, how it will be done? Only if skill sets are increased. You should have the appetite to learn. You should be the people who should groom yourself. You can't say that bank will depute me for training, then I will learn. No. Because you are an individual. You have the onus of managing the risk of your organization. Ring fence the organization. Risk management function is the next. That is our CRO friends, our compliance friends. These are the people who are the second line of defense. They are important, but not so important as the line management. If the business owners do not know what is risk, then even if everybody else in the bank knows everything, there is a huge operational risk to the organization. So be mindful about that. Risk management function and the compliance function is the second line of defense, which need to be protected. And the third line of defense is internal controls, statutory audit, internal inspections, systems, procedures, processes, how they are organized and how they are developed. And they are not static. There is a concurrent audit, but the agenda to the concurrent audit changes with the change in the dimension of the bank, of the business. So, the three lines of defense must be protected. And you should be, time-wise, you should alert me, okay, some 10 minutes before, okay. So, reinforcing role of lines of defense. You should have policies for that. If you want to develop your people competencies, there should be training modules, there should be training systems, external training, internal training, procedures, manuals, who will write, who will vet, and who will train. These are all the wherewithal you need to create. So, reinforcing role of lines of defense, the most important comes the line management. That is why there are three kinds of tools that are used. That is formats. You know that when you do the credit appraisal, there is a 20-page format where different kinds of ratios are comparisons, and there is a format. Like if you want to put up a loan proposal, you just can't write on a white paper that I want to give loan to X and Y. No, there is a format. That is the control system. That is the control system for operational risk. But who made it? When it was made? How long? Is it relevant now? Has to be revisited. So, because that particular format, जिसको हम form बोलते हैं, which we call as a format, like you want to open an account, there is an account opening form. There is a loan form. Everything there is a form. Now, who made the form? Not the God, you and I. When it was made 10 years ago, not relevant. Revisit. Otherwise, you are open to risk. Like earlier, mobile numbers and email IDs were not there. Now they are there. Certain ratios are now there. They were not there when technology was not there. Now, revisit that. So, reinforcing, how will you do? The first is look for the relevance of the formats and the blue book, which we call the manual of instructions. If you have joined a bank and you are reporting to a credit officer, how you will know what form is to be used, what is MOU and what is memorandum of association and what is articles of association? You won't understand. So there is a manual of operations. But that manual of operation, you will learn from that. If it is defective, you are open to risk. So first, please see that the documentation on the basis of which the knowledge in the organization is built is up to date. Second, process. Nowadays, lot of processes are hived off to technology platform. Now, technology platform, you may be saying that I don't know how it is being like algorithm, what we call, models, what we call. We may not be knowing how it is being arrived at, and maybe the app-based lending which is coming now. But you should understand the basis of how a business comes. So first is format, second is process. Third is, what is the outcome? If my forms are not able to give the right kind of information to me, I should change it. So, reinforce the lines of defense and financial institutions. So, revisit them, be sensitive to them. And of course, there are recent guidelines of, as far as the Reserve Bank is concerned, the central banks all over the world, they use a uniform pattern as far as the risk management architecture is concerned. And consistent reinforcing of role of lines of models are very, very important. Now, globally, now this is the 3 lines of defense, which will give you the clarification as to what the first line, business managers. Business managers means not branch managers only, everybody who has something to do with the business. So the first line of defense, if you want summary, business managers. Second line, risk managers, compliance managers, who will be setting standards for you to follow. If you are not agreeable to that, give a feedback. Don't hesitate. If suppose your risk management policy is not implementable at the grassroots level, give a feedback. Because the collective work of everyone else, every one of us, is to protect the organization. As the first line of defense, you have every right to correct the second and third line, because you are doing the business. So, third line audit. Actually, compliance should go to the second line, but there is a audit also, compliance is there. So, there is a compliance at every stage. Even branch, there is compliance. So, compliance is intermingling in all kinds of defenses. So, the risk decisions, the third line of defense, every person in the organization as a risk manager should have certain qualities. What is first line? First line should be good in operations. If I am in the first line, I should be good in operations. I should be knowing what is your risk identification, assessment, and pricing. I should be able to quote price to the customer, no? How will I do unless I know the dynamics of it? And then the second, the risk managers should understand the SWOT analysis of the organization. If you do not know the SWOT of your organization, it's very difficult to play the role of a second line. And third line is the audit and the compliance. So this will give you a conceptual view of what kind of defense, lines of defense that are, and clarify the roles of accountability in operational risk. And my dear friends, there is a fourth line of defense which is evolving now, which is unwritten but is emerging now. That is why the next generation of leaders like you should realize that. What can be the fourth line of defense? The fourth line of defense which is evolving now is the self-service modules which you are introducing, where customer is interacting. There is no banker there. If he doesn't know how to use the systems, if he doesn't know how to put the ATM card and take money, your ATM is gone. So the fourth line calls for financial and digital literacy to your customers. How will you do that? It's a massive job. Your number of employees may be 10,000, but number of customers are 10 crores. How are you going to manage that? That is where we need social media. Social media will protect you against. It will build capability for the fourth line of defense. That is the users of this banking system. If your customer is well versed, half of your work is done. So the fourth line of defense which is evolving now, which is an unwritten development that is taking place, is the familiarity of your electronic delivery models to your customers. That is why spend some time, your organizations, on imparting financial and digital literacy to your customers using social media. Because that is why everybody is having Facebook nowadays. You are a Facebook member or LinkedIn and all these things are coming up now. Why it is coming up? Because of the fourth line of defense. If they do not know how to do that, like I used to work in Dubai, so they used to have two kinds of cards, ATM cards and mobile cards. Same size, same type. The persons, instead of using ATM card, they used to put phone card because they are not literate. And we used to get a siren in the upstairs that something has gone wrong. There used to be a big buzzer. Everybody used to rush, kya hua? Then we used to see that the wrong card is put. That is the fourth line of defense. That means it has the susceptibility to malign your digital ecosystem. Suppose you have cash accepting machine. Nowadays, there are cash accepting machines also in the kiosk. If you have a cash acceptance machine and he doesn't know which slot to put the money, his account is not credited and the money falls somewhere and somebody picks up, then you are gone. So that's the kind of risks that is called the fourth line of defense. So you should develop wherewithal to educate your users from time to time, that this is the way in which you should use our self-service modules. Now in India, RBI has given a direction that commercial banks can open DBUs, that is digital banking units, that is unmanned branches. Unmanned branches, liability and credit, liability and assets both will be used. So what should be the degree of literacy that the potential customer should have? They can, unless they are aware, then the whole DBU will go haywire. So you should be mindful about that. Now again summing up, first line of defense is doers, second line of defense is oversight team, third line is the investigators. Now, what is the Indian perspective as far as how it is being organized? It is nothing different. As per the global best practices, every country moves, and so is India as far as managing risk is concerned. Risk management committees of the board, You must have a risk management committee, subcommittee of the board, and continuous strengthening of the 3 lines of defense. How you are going to do that, and institutionalizing the position of chief risk officer and chief compliance officers, who will be, what is the specialty of CRO or CCO? The specialty of a CCO and CRO is the independence. If independence is not there, then he is like any other employee. So the very purpose of defense is lost, second line of defense. So you must protect the position of the CRO and CCO, especially as far as independence is concerned. If he is giving a view, that should be respected. If the CCO's view or the CRO's view is not respected, then there is no point in having. It is just like any other numbers that you have in the employees' roles. So, institutionalization of CRO and CCO is very, very important. And now RBI has extended this to even NBFCs having assets of more than 50 billion, that is 5,000 crores. Those NBFCs which are having a balance sheet size of more than 5,000 crores should also have a CRO and a CCO. And the prompt corrective action, which is triggered in the banks, will also be triggered in the some big size NBFCs from October 2022. That is the Indian way of managing the operational risk. Because if you are not making CRO mandate for non-banks, then there is a huge risk transmission from non-banks to banks and banks to non-banks. There is a lot of togetherness as far as the financial markets are concerned. Fintech companies, neobanks. Neobanks means branchless banks. The saying goes now, banking is important, but banks are not important. So long as you can give the services through virtual mode. We have not arrived to that level, but the thinking has arrived. And that is the beginning of setting up DBUs, that is digital banking units. Maybe that it will start in many of the countries. And virtual banks, that is branchless banks. Everything through internet. These are all some of the things. And if these things comes, then what is that? The huge risk. Because if our customer is not familiar, like what has happened during pandemic time, KYC through video, everything through your contactless mode. So contactless mode is good, but you have to manage operational risk. Because you are giving more power to technology to influence your risk and your balance sheet. And that's the huge risk. So, extend. RBI sets up central fraud registry. You know, frauds do happen. And frauds can happen because in large organizations, however good you are, then there could be some stray cases of fraud. Then what happens? There used to be a huge lag period between the frauds occurring and frauds reporting. Like if you take the case of Punjab National Bank, again back to Punjab National Bank, then if suppose there would have been some kind of reporting system, then maybe that it could have been detected early. So now RBI has come up with a fraud registry where online you will be informing as soon as some fraud happens, because it will be transmitted to the whole system. See, why fraud is to be reported to the central bank? Because there are two purposes. First is communication. The central bank should know how the banking system is galvanized. The second one is others should know the modus operandi of the fraud so that they avoid this kind of situation. It gives a corrective action strategy. So that's the reason why RBI has set up and mandated banks to begin a process of red flagging the accounts. That is red flag. As soon as something happens, you should segregate it so that it doesn't contaminate the other portion. Otherwise, it can contaminate other assets. So you should do that. I think all of us are aware about loss collection, this internal and external loss data collection. This we might be doing, all of you might be doing, because it is the central bank directives. And maybe that the threshold in India is 10,000 rupees and above. If a fraud happens, then you will have to inform. And computation of capital charge. Ultimately, my dear friends, if suppose the risk manifests, how will you manage it? Only through capital. You should have resilience. You should have absorbing capacity to absorb the losses. So you should have robust capital with you. So computation of capital charge all over Asia, as far as Asia is concerned, because we are not yet matured as far as technology is concerned, data is concerned. We don't have much of data collection as rich as it should be to do the data analytics the way it is intended. That is why we are using basic indicator approach as far as computation of capital charge on operational risk is concerned. Now, how it is done? Very brief. The revenue generated in the last 3 years, take average, 15% is the capital charge. But the whole balance sheet size, you should you can assign weightages so that a risk in corporate loans are higher than loans in agriculture, because agriculture there is securities are more. So if you want to distinguish, then you can give weightages. But this is all coming under basic indicator approach for capital allocation for operational risk. Because when you are computing capital, you should be able to segregate credit risk, how much capital, operational risk, how much capital, and market risk, how much capital. In the whole basket of capital, you should be able to segregate. And so is the operational risk. And these are the prompt corrective actions which I have already discussed. How much time do you have now? You 20, 25. Very good. So now reforms in India, as far as now how reforms are taking place as far as operational risk is concerned, means I am giving the Indian perspective because it will give some kind of light on that. RBI way back in 2014 has set up a committee known as capacity building. Capacity building, Gopal Krishnan committee report. It can be anybody. You can have anybody, but the intention is what? Intention is how to streamline the capacity of the human resources in the banking organization and also non-banks. See, as far as India is concerned, banks and non-banks, they work in cohesion. One example I will give, just to give you an understanding. As far as banks are concerned, March 2020 data, which is now available of course, now the annual report of 22 has also come. But as far as commercial banks are concerned, 180 trillion Indian rupees. 180 trillion. 1 trillion is 1 lakh crores. And NBFCs, 32 trillion. That means the size of NBFCs is progressively CAGR of 25%, whereas banking CAGR is 12.5 to 13% because the base is more. See, there is a base space syndrome. If your bank is a 1 lakh crores bank, to have a 10% growth, you need to have 10,000 crores. But if I have a bank with a 5,000 crores, then 100 crores means I have 20% achievement, isn't it? So, just to give you a flavor of NBFCs and banks in India, why both are important, and this committee has worked for both banks and non-banks. That it is not only important to upgrade the, it is not the question of only upgrading the, your skill sets. I think all our senior friends will understand. It is much more difficult to deploy people in the right place. You may have people with competency, but how to segregate them? First is talent mining. That is why you have assessment centers now. In India, there are assessment centers which will interview you, and they will also put some kind of tests, and then they will say psychometric tests, and then they will say that you are good for agriculture credit, you are good for controlling the branches, you are good for operational risk, you are good for credit risk. So they will be able to grade you. That is called assessment centers. So Mr. Gopal Krishnan committee has gone very deep into the competency levels of people. That is the Indian perspective which I wanted to bring. Then it said, it came to a conclusion that critical positions in the banks need to have latest trainings from accredited training institutions. Now, for the purpose of accreditation, like in India, in Nepal, the NBA, you can NIBM in India, or IBA, Indian Banks Association, and then you have IIBF. And nowadays, because it is a business, even IIMs are floating a lot of skill-based training programs. To cut short the discussion, Gopal Krishnan committee has given a lot of recommendations. The most important is to have a chief learning officer in the organization. That is called CLO. I don't know whether Nepal has that chief learning officer. Nowadays, earlier, our HR head used to look after the functions of your skill building of the employees. But now skill building is a separate business. And more important, if our young friend is good in credit, he will have to establish that he is good. And he has to go through a process of certification after training by an accredited institution. Unless it is there, he cannot be posted in that department. It has taken now 2014 to 2022, still it has not set. Because 1 million people are working in the banking system in India. Million people, 1 million, 10 lakhs. Even 1.1 million now. So, such a huge workforce. How will you train? How will you segregate? How will you deploy? How will you separate them? Now, suppose somebody is very good in foreign exchange, but he is in a remote area, then you will have to bring him to the urban areas, metro areas where there is foreign exchange business. Business and people have to be aligned together. Now, you are a very good expert in trade finance, and you are in a semi-urban branch. So, you are good in trade finance, you will have to be brought to a place where there is trade finance business of the bank. So, these are all some of the constraints. But the idea that I just wanted to leave with the audience, you need to certify yourself what you are good at and inculcate that habit. Inculcate the habit. And your documentation should speak that you are competent there. Now you may say that I am very much interested in foreign exchange and I have read so many books of foreign exchange. But I will not believe that unless you have a certification from an accredited institution. Otherwise, everybody will say, I am very good. How can you separate? So, there is a necessity of accredited institutions in the country which need to certify the competency level of the people so that we have a groomed workforce over a period of time. Over a period of time, we have groomed workforce who are competent, who can read the riskiness, readability of the riskiness, sensitive towards risk, committed towards risk, knowledge of risk, and how to keep the risk away from the organization. These are the nuances which one should learn. So, among others, it recommended CLO of the position of general manager. Because otherwise nobody will listen. Now suppose you say that I am a senior manager, chief learning. He said, there is no credit, like your CRO is an independent person, people will listen. But that is why he said that he has to be a very senior guy in the organization, so that people will listen to him. Now if you ask a chief learning officer in the bank, out of 10,000 officers that you have, how many are recently certified as good for credit? He will be able to tell you. How many are now like recovery of loans, you know? Earlier, recovery of loans means I will go to the borrower and ask him, please pay, isn't it? But that is not the way now. Now, invocation of legal provisions for recovery. Like in India, there are debt recovery tribunals. And there is NCLT, that is National Company Law Tribunals. Now, if you do not know how to invoke, so that is why the NPAs in the Indian, again I am touching this in the context of operational risk. If you do not know, then this is a risk. So, NPAs, there are 3 divisions of NPAs. You may say that this is NPA department. No, this has got 3 divisions. First is compromise. Recover as fast as possible. There has to be a separate line, experts who will be only having knowledge of how to compromise with the customer, so that immediately money will come, because the net present value of money is very important. So how briskly you do the transaction depends on you. Then the second one is debt resolution. Debt resolution is you will have to recover through legal means. And the last one is you will have to settle. You will have to take the haircut. That is what we call in India haircut. I don't know whether it is called here also as haircut. But the thing is, if my outstanding balance is 10,000 crores, if I have got a recovery of 8,500 crores, 1,500 crores has to be debited to profit and loss account, and I will have to close the deal. So these are the nuances which the employees have to acquire. Then you have to have a certification in the legal matters. If you are not having certification, there is no point in posting you there, because you will say, I am not LLB. So I know how to open an account, but I don't know how to do the debt resolution. So you need to be certified. So why I am giving more emphasis on this is, every one of you is a competency which is inherent in you, which need to be mined. And you can become experts in that area, so that you are more useful and operational risk can be People to be posted in specific specialized areas like risk management, credit appraisal, forex, treasury, derivatives, and all other sensitive have to have certification. That is what is the. Then the CRO. Now CROs also need to be groomed. And board of directors, I was secretary to the board, so I can understand the nuances of it because the IDs, independent directors. A board will always consist of nominee director, independent director, and whole-time directors, non-executive directors. There are different kinds of directors. Now, if you become a director or you become a CRO or CCO, it is not the end of the game. You need to be upgraded. So, it is very essential that key people in the organization, key people, have also to be trained because they create the vision for the organization. Now, if they do not have those competency levels, it becomes difficult. So, head of internal audit is, there is also head of internal audit and oversight and assurance function, and the CRO has direct reporting to the MD of the organization. So, these are all some of the initiatives that India would like to, has implemented in the recent past. Human competency, first you should know that the inventory of your people, what kind of skill sets they are having, what kind of capacity they are having, what is the potentiality that they are having, what is the intentions that they have, what is their career aspirations, and these are all some of the things that they need to do. And then the positions have been created so that accountability is fixed. Now, RBI will not ask anybody if there is a deviation in the risk. They will ask the CRO. If the compliance is weak, they will not ask the what you call retail head or lines of business heads. They will directly ask the CCO, what are you doing here? And you are our watchdog in the organization. You are our representative. And what are you doing? So these are all some of the things which we need to do. And we need to institutionalize. Now, how third line of defense is strengthened? Risk-based internal audit. India used to have camel-S model of inspection of banks. Camel-S is a model. It will take 2 hours if we have to deal with camel-S. Camel-S is nothing but, briefly, C is capital, A for asset quality, M for management, E for earnings, L for liabilities qualities, what is the liability composition business mix, camel, S means systems and procedures. That is the camel-S model of central bank inspection of the banks. From camel-S, they have moved to risk-based internal audit. Now, risk-based audit, RBS, risk-based system. I think, I don't know about Nepal, we have RBS 2014. That is as per the BIS guidelines actually. Now, what is RBS and what is camel-S model? Nothing. Very, very simple, that any activity that you do will be converted into a risk factor. Whatever is your exposure that you have taken, whatever is the line of business that you are doing, what is the distribution of your balance sheet assets. If you have 1 lakh assets, from where they are coming? What kind of risk they emit? What kind of risk they can manifest in future? It is not today, tomorrow, how it is going to behave. So if I take the balance sheet of your organization of last 10 years, I can have some idea of how it has moved. and then I will extrapolate and see how it is going to behave in the next. And factoring the three risks: geopolitical risk, your catastrophic risk, and climate risk. These three risks you should not ignore any time. And the VUCA environment, because they are just like hovering here. You have seen drones, no? Drones. Like drone, it is there in our system. It is always over our head and zooming and zooming. So we should be able to protect ourselves from that. So that's why we need to have those understandings. So risk-based supervision is an improved version when compared to numeric-based audit. Numeric-based means I will see how much loan you have given, 10 crores, tick, 100 crores, I will tick. Now no ticking. Conversion into how much risk you have taken. And there are two kinds of capital. One is minimum capital, that is a regulatory capital. And after risk-based supervision, if they say that the risk is more than what is needed, then you have regulatory risk capital. They will add capital to you. They will say, you do any kind of business, I will measure your risk and I will prescribe additional capital which you need to manage. Like we have in India DSIB, that is Domestic Systemically Important Banks. I think you also must be having here. Now DSIB means Domestic Systemically Important Banks. What does it mean? That means if they collapse, the financial system may collapse. That is the financial stability, Global Financial Stability Board has prescribed that you should classify your institutions. Which institution is so important, if it collapses, the whole system will collapse. State Bank of India is the DSIB in India and HDFC Bank. These are the two banks which are classified as DSIB. Now, why I am telling you about this? Because they need to maintain additional capital because they are more risky. If they are not prudent, I am not prudent. That is the problem. So their sustenance is important for me. That's why now the whole global system believes that if they want the risk resilience, you need to have more capital. That is the reason why Basel Committee 3 has brought CCB, capital conservation buffer, of 2.5%. 8% plus 2.5%. In India, it is 9% plus 2.5%. 11.5% is the minimum capital adequacy ratio. But if you have minimum capital adequacy ratio, you can't do business. Because the moment you increase your balance sheet size, you dip your capital adequacy ratio. It is a denominator and numerator. So you should have buffer. Any capital adequacy ratio has to be much higher than the minimum. That's the requirement. So they introduced RBI, risk-based supervision, and they have extended it to NBFCs, bigger NBFCs. Gradually, what RBI is doing, there has been a, this is again in the context of operational risk, because we should understand everything in the frame of operational risk. They have set up a committee recently, which is known as the internal committee of RBI, which has recommended that NBFCs which are in operations for more than 10 years and which have a balance sheet size of more than 50,000 crores can apply for on-tap commercial bank license. That is called on-tap bank licenses. Okay. On-tap bank licenses. So that is the leverage given to NBFCs. So what will happen? Today's NBFC will become tomorrow's bank. Now, if they become bank, then what is the risk? So that is why they have introduced RBI. That is why they have introduced prompt corrective action. That is why they have put CRO and CCO there. Everything they are matching. They are reducing the leverage between, that is to manage operational risk. So, yeah. So, now what government is doing? Now RBI has done Indian way of strengthening the system. Now RBI, government is also vexed with this kind of frauds that are happening in the system. So what they have done, they have put up National Financial Reporting Authority, NFRA. It's a regulator. The chartered accountants who are not doing the proper, wherever there are, because the collapses which we have seen, these are all certified by our competent friends, professionals. So there is an oversight body now. The government says that there is a oversight body. And then the laws relating to CA, CWA, means chartered accountants, cost and works accountants, and company secretaries bill has been amended. That empowers the disciplining of these three, because unless you are a qualified company secretary, you can't, you need to have, if you are a listed company, you must have a company secretary as the secretary of the board. So that is the requirement. And it has also brought into force the Fugitive Economic Offenders Act. That is, those who commit fraud in India and go out of country. There are classic examples. You can read a lot of literature on that. So RBI, banks, and government, they are collaborating together to create an operational risk mitigation environment, ecosystem, so that in future, at least we will be paving the way. And that is what Gopal Krishnan Committee report says, that the people competencies have to be gradually improved to bring uniformity and all competent people manage the banking industry. So it's a great pleasure talking to all of you. Thank you so much. And I look forward for any feedback. You can pass it on to the people here. And I will definitely try to, it will be my pleasure to respond. Because of the timelines, I don't know if there are any time left. Otherwise, it has been a very, what you call a good experience for me to talk to all of you, because the facial expressions are a welcoming thing for me. And I also thank our Kumar sir for giving this opportunity to me. And also Karuna has been, and Mr. Thapa, all these people have been coordinating with me. And really it has been a very exhilarating experience for me to be here this morning to talk to all of you. And I take this opportunity to wish all of you all the best in your career, in your personal life, and all your aspirations should be fulfilled. But all aspirations should have an action point and an implementation strategy. Thank you very much. All the best.
Thank you so much, Dr. Rao, for your insightful presentation from the Indian perspective on risk management. And we look forward to a long-term collaboration with you. And now we have a small token of appreciation to Dr. Rao, and I would like to request Kumar sir, the CEO of National Banking Institute, to do the honor.